give you a little bit more about me. So my name is Trey Fairman. I'm the newest member. I've been here about 14 months on the Transamerica Advanced Markets team. I am a tax attorney by training. I have a master's in tax law. I've spent over 30 years calling on most of the major Wall Street firms, private banks, accountants, attorneys. But I think most importantly, I spent that time doing exactly what you're doing. I was out meeting face-to-face with clients and their tax advisors and legal advisors talking about selling life insurance. So we're going to talk today about business owner planning. If we could jump to the next slide. And we're really going to kind of talk about three areas, which I call the big three, right? So executive bonus, key employee or key person, and then buy-sell agreements. Now, it's important to understand that these ideas blend. So they do function on their own, but most times when I'm talking with business owners towards the end of that meeting, they'll say something like, Trey, this is great. Can I just purchase a insurance policy for my spouse? Absolutely, right? So whether we structure it as a bonus policy or a key person policy, or if it's part of a buy-sell agreement, again, these ideas are separate, but they do also blend. So throughout today's presentation, I'm going to give you a little bit of what I call language and tools. So make sure you have your lucky Transamerica pen handy. And the first one that I'm going to sort of share with you is something that I picked up along the way, that as advisors to business owners, our goal should be, so if you're meeting a business owner and they're like, what do you do? Well, as an advisor to a business owner, my job is to make sure, or your job is to make sure, that when the owner exits their business, and every owner exits their business, when the owner exits their business, they leave with the value and the money they've worked so hard to build. Fact of the matter is, business owners work 25 hours a day, 8 days a week running their business, and they rarely get to peer share. So we're going to walk through some ideas today. So make sure you have your pen handy, write down some of these language and tools, and maybe just jot down a list of clients too, as ideas kind of pop up in your head. All right, next slide, please. All right, so we're going to start with 2 slides of just some general stats, and then I'm going to give you some more language and tools, what I call the 4 reasons why to work with business owners. Make sure to write those down, and then the 3 opening questions to use. So as you see up here, 99.9% of all businesses in the U.S. are small businesses, meaning 500 employees or less. I think more importantly, on the bottom, you see a little over 46% of the U.S. workforce works for small businesses. Now, within that stat, it's estimated there is approximately 100 million people, employees at small businesses, that do not have access to a workplace retirement plan. So an executive bonus plan works really well for those individuals. So keep that in mind as we sort of walk through this. Next slide, please. Okay, we're also going to talk a little bit about key person planning, as you see up here. Key employees know they're good, and studies would show us that roughly 51% of them are actively looking for new jobs or keeping their eyes and ears open for other jobs out there. When businesses lose good employees, a lot of money's lost. As you see here, it's estimated up to $1 trillion annually. That's on the macro scale. If we kind of drill down to that third point, it is estimated that the cost to rehire a new employee can be 3 to 4 times that person's income. And now whether that person leaves the business, we can fix that with a executive bonus arrangement, or unfortunately, if that key employee was to pass away, we can solve that need possibly with a key person policy as well. Okay, next slide, please. All right, so this is going to be our agenda. I'm going to share with you some language and tools, but before we do that, we're going to have a short little poll here for you, so you're going to see that pop up. Give this just a few seconds here for everyone to answer. All right, so we're going to leave this slide up here, but again, grab your pen, because I'm now going to share with you what I call the 4 reasons why you should be working with business owners. And then I'm going to share with you really what I use, the 3 opening questions. So quickly, the 4 reasons why. Number 1, this is an often overlooked area. Your competition usually only talks to individuals about individual planning. There is a huge need to talk to business owners. And again, as I said before, business owners work 25 hours a day, 8 days a week, so they're yearning to hear this sort of information. Okay, number two, by talking to business owners and being an agent that not only helps individuals with personal planning, but business owners with their business planning, it sets you apart from your competition, makes you memorable in a good way. Okay, number three, if you do it properly, you're not only a resource for your business owner clients, but by involving their tax advisor, their accountant early in the process, we're going to walk through how to do that. That accountant also has learned that not many agents talk to business owners about insurance planning. So if you're doing it and talking to individuals about planning for their business, when you involve that tax advisor has another 20 or 30 possibly business owner clients. So you can organically grow your prospecting list by getting comfortable talking to business owners about how to use life insurance in their business owner planning. And then number four, it actually helps protect the personal planning that you or a prior agent already did. So let me walk through quickly what that means. Let's assume before you met with this client who owns a business, the prior agent only talked to that person about personal planning, and that prior agent may have helped your prospect secure life insurance to pay off the mortgage, send the kids to college. But by not talking to your prospect about their business, the prior agent didn't know that that business owner probably has a outstanding business loan, like most businesses do. Let's say it's for $1.5 million. Now, I've worked with dozens of banks over the years, and most, if not all, of those business loans made to small businesses contain a clause that says something along the line of, if the financial stability of the business is impacted, the lender has the right to call that note due. And unfortunately, when an owner of a business passes away, that's exactly what happens. The business suffers financially, struggles for a period of time, maybe even fails. So by not talking to your clients who are also business owners, you may help them secure life insurance to pay off the mortgage and send the kids to college. But unfortunately, if you don't talk about the business loan, if the owner was to pass away, the bank may show up and call that note due, and all the death benefit that was earmarked to protect the kids and the surviving spouse, pay off the mortgage, send those kids to college, that money is gone because the banks will move on that note and then collect that money. So again, it's important when you're talking to individuals that own their own businesses, not only about personal planning, but also talk to them about business owner planning. Okay, so that's the four reasons why. We're now going to talk about the three opening questions. Okay, so the three opening questions. As I said before, business owners are super busy, right? They work 25 hours a day, 8 days a week. They rarely get to peer share like we're doing here. So over the years, when I did meetings with clients, I would always walk in, put my folder with my illustrations and notes on the desk. I'd have a short little agenda, but I would always start every meeting by simply saying, Mrs. Client, before I get started, is there anything important you'd like to talk about first? And more often than not, especially with business owners, the business owners would just say, just tell me what other business owners are doing. So the number one opening question should be this. Do you have 15 or 20 minutes to talk about what other business owners like you are exploring when it comes to planning for their business? I'll say that again. Do you have 15 or 20 minutes to talk about what other business owners like you, it's important to say like you, are exploring when it comes to planning for their business? So that's the simple, easy opening. Assume they say yes. Then the second question should be, what is the current tax structure of your business? You're trying to find out whether they're an S Corp or an LLC or possibly a C Corp. Now, it's important to know that, but more importantly, the reason we ask the question is because most business owners don't know the answer, and that's okay, because that's a great opportunity to say to the business owner, well, that's okay, most owners don't know. Is it okay if I call your tax advisor or accountant, ask them, get the answer from them, and then also invite them to this conversation? It's very important when working with business owners to involve their accountant or bookkeeper or tax advisor, because that business owner will talk to them at some point. We'd like to get them into this conversation as soon as we possibly can. And again, the reason for that is by doing a good job for the business owner, allowing that CPA, let's say, to see what a good job you're doing, that CPA will then have another 20 or 30 business owners for you to go and then help them also. And then the third opening question is what I call a non-life insurance question. So this is really meant to be a springboard for the rest of the meeting. There are three variations of this. The first one is, what are you doing today to be successful that you weren't doing 5 or 10 years ago? What are you doing today to be successful you weren't doing 5 or 10 years ago? Now, they may say something like, oh, you know what, we hired Karen 6 months ago. She's our #1 salesperson. She's doing awesome. So that would then clue you in that maybe the next part of the meeting you should talk about executive bonus planning for Karen. Another variation of this question, and we have a question like this on our fact finder, is what changes are you focused on now to be successful this year and next? What changes are you focused on now to be successful this year and next? I was reading a fact finder a few months ago, and the physician who was answering that question said, oh, I have 2 friends that are going to be retiring in the next year or 2, and I plan on buying their practices from them. So with that sort of question, we then learn that that physician is going to probably have to borrow money from a bank to purchase out the practices from his 2 friends, and we can talk to that physician about key person planning, right, to protect the business from the outstanding business loans that he'll have to borrow to purchase the firms. All right, so that's the second variation. Now, the third variation, I don't often use this because it's somewhat negative, but it'll show you what the point is. It's just simply what keeps you up at night, right? Just really trying to have that business owner sort of talk to you, share their dreams and goals. And then really, this is just a conversation. So just get comfortable kind of talking about this. As you see here, the big 3 ideas, executive bonus, key person, and buy sell, they each run separately. But don't just think it's just one versus the other, right? These blend together. Okay, so we're just going to kind of walk through these now one by one. Next slide, please. Okay, next slide. Okay, so at its core, executive bonus plans, also called Section 162 plans, because that's the tax code section, it is just simply a way for a business to pay a bonus to an employee, all right, that is directed to fund a life insurance premium. We're going to look through a graph in just a little bit how that works. Okay, now it's important to understand that those bonuses are tax deductible, okay, on the employer side when they pay it, but it's taxable income to the employee. Okay, so if you're talking to a business owner about setting up an executive bonus plan for themselves, which is a really good tool, but if you're talking to an owner, remember an owner for a pass-through like an LLC is the business and the employee. Right? So bonus plans are absolutely tax deductible to the business, but it's taxable income to the employee. When you're talking to a business owner, they do not get an extra tax deduction on a bonus plan. There's still a lot of good reasons why to do it. I'm going to walk through those. But just keep in mind, when you're talking to an owner, that the taxation, if it's a pass-through, meaning an S-Corp or an LLC, it's not an extra tax deduction. It's no worse than not doing it, okay? But the taxation's just a little different. We're going to chat a little bit more about that. All right, down on the bottom, as you see, these are great tools for attracting, retaining quality employees. Think about, I had a client that ran a nurse anesthetist firm. It's like a physician's assistant firm. This was in Arizona. He was doing great. He had about 150 nurses on staff, and he was having a problem keeping his top nurses. The top 5 or 10 would leave because competitors would come and offer them more money. So we worked with him to set up a bonus plan for his top 5 or 10 nurses to tie them to the business for a period of time, for the next 5 to 10 years as an example. Okay? Executive bonus plans funded with IUL policies are a true overlay and in many ways much more flexible than a qualified plan, meaning a 401k plan. So just because you would be talking to a business owner that has a 401k plan in place doesn't mean this isn't another good solution for them. This works as a true overlay to a qualified plan. Okay, and then again, if you've got a business, think about a restaurant owner that has 3 restaurants and has a really good manager at each of those restaurants running those. That owner may want to talk and implement a bonus plan for one for each of the managers, and these can be incredibly flexible. They don't have to be exactly the same. All right, next slide, please. All right, so I'm going to start on the right-hand side of this slide, and the good news is Executive bonus is the same sales conversation you have with individuals about overfunded IUL policies. It's the same conversation. The reasons that you talk to individuals about why a overfunded, minimum face amount, maximum premium, non-MEC policy is a good idea. It's the same conversation in a executive bonus plan. The taxation is a little different, like we were chatting about. Okay, but it's the same reasons. Again, tax deferred growth on cash value, tax-free income, tax-free death benefit. Okay, all those same reasons. So it's not a new sales conversation, it's the same one. On the left-hand side, what I talked about on the prior slide, just to reiterate it here, this is a way for businesses to set themselves apart, okay, attract good employees, keep the good ones they have, okay? Again, remember that bonus paid from the business is tax deductible to the business, okay? Now, the rules are the IRS requires us that this must be reasonable. Okay, so the tax code says it must be reasonable. As a good rule of thumb, I would say reasonable is 30 to 50% of that executive's income. So if you remember back to the third opening question, what are you doing today to be successful you weren't doing 5 or 10 years ago? Answer, oh, we hired Karen, she's our number one salesperson, she's doing great. I would then ask a follow-up question. That's awesome. How much is Karen earning? And if the owner says, oh, about $100,000 a year, you then know in your head by using the rule of thumb of 30 to 50%, you could set up a bonus plan for Karen of somewhere between $30,000 to $50,000 in IUL premium. That's 30 to 50% of her annual income. Okay? These are non-qualified, meaning completely flexible. We don't need to have IRS approval. We don't have to worry about third-party admin firms and tax testing. Okay, and again, as I said before, it's entirely flexible. If, again, we have an owner of 3 different restaurants, Manager 1's bonus plan could be a premium of $5,000 a year for 5 years. Manager 2 could get $10,000 a year for 3 years, and maybe Manager 3 gets $6,000 a year for 7 years, right? It's incredibly flexible. All right, next slide, please. Okay, now it's important to understand, when you're filling out the application for a bonus plan, the employee is the owner, the employee is the insured, and the employee gets to pick their own beneficiaries. The business is just the payor, okay? So because of that arrangement, the employee owns the policy. So it's important to note that if we were to set up a bonus arrangement, let's say it's a $10,000 premium for 5 years, after that first premium's paid, because the employee is the owner of the policy, if they leave the business, they can take the policy with them, and the business can't do anything about it. Okay, so we often talk to businesses about implementing another sort of side agreement. It's called a restricted executive bonus arrangement, or just a REBA for short, and that really ties that employee to the business. It works very similar to a 401k vesting program, right? In many 401k plans with employer matches in certain plans, that employee doesn't have access to all of that matching money right away. They have to wait 2, 3, 5 years maybe. A REBA works exactly the same. Okay, it could say something like, employee, we're going to fund $10,000 a year for 10 years into this policy. If you leave after the first year, you owe us 90% of the premium back. If you leave after the second year, 80%, third year, 70%, so on and so forth. Okay, so it really ties that employee to the business, which is the whole goal of this. Without the REBA, that employee can just take the policy, and that employer can't do anything about it. Next slide, please. Okay, so behind the scenes, what that REBA does is we would then file a collateral assignment on the policy that restricts that employee's access to surrender, borrow cash value, okay, or collaterally assign that policy. So again, we don't have to do the REBA, it's not mandatory, but again, that's a way for that employer to tie that employee to the business. Okay, next slide, please. All right, so let's just kind of walk through how this works here, right? So we've got the employer at the top. Let's assume it's a $10,000 bonus, right? So the employer is going to pay the premium directly to Transamerica or the insurance carrier. Okay, now that's tax deductible to the business, like we had mentioned, okay, but it's taxable income to that employee. Okay, now as we mentioned earlier, the employee is the owner of the policy, and the employee gets to pick their own beneficiary. Okay, now if we just pay money towards a premium, that's called a single bonus. right? So that $10,000 in a bonus being paid as a premium into that IUL policy, that employee would have to pay income tax on that. We could set up what's called a double bonus, where the employer not only pays $10,000 as a premium, but also gives that employee extra money to pay the tax on that premium. So that's what this optional bonus gross up is. The employer says, not only am I going to pay $10,000 in the form of a premium payment, I'm also going to give you, the employee, some extra cash to pay the tax on that. Okay, both of them work very well. It's not that it's all one way or the other. It's completely up to the individual needs there. But again, just keep in mind that bonus is taxable income to the employee. I would say typically on larger bonus cases, that employer is going to give that employee extra cash to pay the tax on that. But we do see a lot of groups just doing single bonus plans, maybe $200 a month for the top five employees of the business. Okay, so again, single bonus, double bonus. Only difference is, are we giving extra money in cash to that employee to pay the tax? Okay, next slide, please. All right, so let's just kind of walk through just a quick little numbers here. I'm going to kind of go through this quickly. So we've got Mike, right? So remember, third opening question, what are you doing today to be successful you weren't doing 5 or 10 years ago? You know, Mike's really hit the ground running. He's doing really good. Mike's 50, plans on retiring in about 10 years. He's in a 24% tax bracket. So as you see in the middle, the business says we're going to pay $35,000 as a premium, right? So that rule of thumb, 30 to 50%, right? Probably means Mike probably earns about $100,000 a year. And we're going to use a IUL policy of about $500,000. Now, this business is also going to give Mike some extra cash to pay the tax on that. That's estimated to be about $11,513. So all in, from the business's perspective, they're paying $35,000 in a premium, right? And then they're also giving Mike extra cash of $11,513 to pay that premium. To pay the tax on the premium. So from the business perspective, it's a cash flow event of about $46,053. Let's go to the next slide, please. Okay, so from Mike's perspective, what just happened? The business put $35,000 a year into a policy for 10 years, right? Now that was taxable, but remember, the business gave Mike money to pay the tax on that as well. Okay, so Mike has a policy. Again, he hasn't put any money into it. The business did that for him, and the business gave him extra cash to pay the tax on the premium. So $350,000 went in over 10 years. If Mike then retires, right, at age 61 and starts to pull income out of the policy through loans and withdrawals, it's estimated that amount would be about $28,320. Okay, so if Mike lives to the age of 90, he's pulled out about $849,600. Remember, Mike didn't put the premiums in, his employer did, and Mike didn't pay the tax on those premiums because he got cash from his business to pay the tax. Okay, so Mike's pulled out about $850,000. If Mike was then to pass away at age 90, the remaining face amount on that policy is about $302,000. Okay, next slide, please. All right, so that was big three idea number one, right? Executive bonus planning. Okay, so now we're going to talk about big three idea number two, key employee planning. All right, let's go to the next slide, please. All right, so basic question, who is a key employee? The answer is whoever the owner says is key. Okay, whoever the owner says is key. I'm going to say this a few times. If you follow me on LinkedIn, you see that I say this all the time. The owner is the keyest employee in any business. I'm going to say that again for effect. The owner is the keyest employee in any business. So don't think this is a non-owner conversation. It's absolutely a conversation to have with a business owner. All right, next slide, please. Okay, so just as an example, what are some examples of key, right? So employees that have a specialized skill set, think of maybe a two-owner firm that one's a salesperson, one's a product designer, right? There's probably a buy-sell conversation there, but from a key employee perspective, if the salesperson died, the product designer can't go out and sell. And if the product designer died, then the salesperson doesn't have any products to sell, right? So think about firms that have specialized skill sets. Salespeople obviously would be key. Okay, now also sometimes you'll run across businesses, there may be three owners, and two of them are actively running the business, but a third one you don't really find out about in the beginning. They're just contributing capital to the business. Okay, so also keep in mind there's sometimes owners or employees that contribute capital to the business. Those individuals would be key also. All right, next slide, please. Well, I think we have a poll question coming up right now. Is this a good time for a poll, Lindsay, we think? Maybe? Nope, there we go. Thank you. So let's pause a few seconds here. We're going to have poll number 2. Give it about 5 more seconds. All right. Okay, so when we're kind of summarizing what the loss is of a key employee, there could be a lot of losses, right? I mean, if it's a top salesperson, we're going to lose revenue, right? If it's an owner, right, the keyest employee, if they're really leading that business, maybe the business won't survive, right? And in any event, it's going to take time and expense, right? Key employees are key for a reason, meaning they're unique and they're good. So it's not like you can find one the next day, right? You may have to have that owner working overtime. They're already working, as I said, 25 hours a day, 8 days a week. So they got to work more, maybe hire more staff, find a search firm. Then there's training involved. And even if they do hire that new employee early on, the new employee has to get ramped up, right? So there's a lot of loss here. All right, next slide, please. So before we walk through just sort of how this works, because the structure is pretty simple, a good rule of thumb is you can insure a key employee for about 10 times that key employee's income. Okay, so think about, again, third opening question. What are you doing today to be successful? You weren't doing 5 or 10 years ago. We have Karen. She's our number 1 salesperson. She's doing great. Awesome. How much is Karen earning? About $100,000. You know in your mind, if key person makes sense, we can insure Karen for 10 times her income. That's about $1 million. Now that number is a little bit flexible, right? Sometimes it can be 12 or sometimes it's 7. But again, a good rule of thumb for key person insurance for a death benefit is 10 times their income. Okay, so it's also important to understand that when we're talking about key employee insurance, we have the business. So filling out the application, the business will be the owner. The business is the beneficiary. The business is the payor. The employee is just the insured. Okay, so again, if you're filling out the application for key person coverage, policy owner is the business, insured is the employee, beneficiary is the business. So in that sort of arrangement where we have employer-owned life insurance, that brings up a tax code section 101J. I'm not going to spend too much time on this, but just know that if you have a situation where a business owns a policy on an employee and is the beneficiary of that policy, there's just one extra step. It's called a 101J disclosure, 101 lowercase j. Just a simple 1.5 page. Transamerica does not need to see that. Some other carriers do. But it's basically notice and consent. It in effect says, dear employee, we the business are going to purchase X amount of insurance on you. Please consent to us owning the policy and we're going to be the beneficiary. Okay, so again, that 101J disclosure, signed, notice, and consent. It's important to do that because if we don't do that, then the death benefit's possibly income taxable to the business. Okay, so it's important to get that 101J disclosure signed up front. Keep it in the file if the carrier does not need to see it. Okay, so employee or key person is the insured. Business is paying the premiums. Okay, no, these are not deductible. Okay, these are not deductible. And that should make sense, frankly, because the death benefit's income tax free. Right? So again, in this arrangement, the business is the owner, the business is the beneficiary, the business is the payor. That key employee is just the insured. Okay, now I often get asked the question, well, why would a key employee agree to do this if it doesn't benefit their family? Well, I would say maybe they're not as key as one might think, but more importantly, that's a great opportunity to talk about a bonus arrangement too. Say something to the key employee, oh, if we think you're key, we would like to insure you to maintain our success if something happened. And if you do this for us, then we'll set up a bonus plan for you. So it's a way to broaden that conversation. Okay, next slide, please. All right, so now we're going to look at, this is often term insurance, okay, but it doesn't have to be. So let's assume we have Anna here. Anna's 45. Okay, she's the head of development for the business. Now she generates, as you see on the top right-hand side, 25% of the firm's revenue. So the firm brings in $4 million a year. She generates 25% of that. She's, again, 45 years old. Let's jump to the next slide here. So part of this, in this green section, right, Anna's driving 25% of 4 million, but as that 4 million grows, right, so the business may be doing better next year, 25% of a bigger number next year is more than $1 million. So whenever I'm talking to advisors about this, I always say, look, she may be driving 25% of 4 million, which is $1 million today, but that number is going to grow. So maybe we should consider purchasing more insurance. So under that increasing face amount concept, sometimes if the business has extra cash flow, we can talk about using a IUL policy. Right now, it's clearly going to cost more, right? So here it's a $24,000 annual premium. But as you see in the last red column here, that death benefit is growing along with the projected revenue increase. Okay, so again, this is often term insurance, but doesn't have to be. Okay, if they have extra cash flow, this may make sense. Now we often see this. Again, the owner is the keyest employee of any business. In real estate development firms that have to qualify for bonding every year, part of that exercise is they have to provide a business balance sheet to the bonding agency. If we do a key person policy for an owner, we may want to consider using a permanent policy because the business can carry the cash value on the books as an asset for that business. Okay, so again, just keep in mind, key person is often term insurance, but doesn't have to be. Okay, there are plenty of reasons why we may not want to do it. It does cost more, but one of the advantages is we get an increasing face amount to keep up with the future value of that key employee. And then we also get the advantage of being able to carry the cash surrender value of that policy on the books. All right, next slide, please. Okay, so again, like we had talked about, first and foremost, and I think one of the other points, whenever talking to business owners, keep in mind, business owners are very focused on financial risk. It's more of a financial risk, meaning a death benefit conversation. It's more of a death benefit conversation many times than it is a building cash value conversation. So that's a little bit different nuance when you're talking to business owners versus individuals. But as we said, permanent products not only provide a death benefit, you've got growth potential in those indexed accounts, and then again, much like any other IUL policy, we have tax advantage, tax-free access to cash flow and then income. All right, next slide, please. Okay, so that was the end of big three idea number 2. So now we're going to the last one, buy-sell agreements. Now, in reality, there's probably 5 or 6 variations of a buy-sell agreement. I'm just going to talk about a real simple one, which is called a cross-purchase agreement. So if I'm in business with Joe, let's say, if I die and I own half of the business, legally speaking, my half goes to my wife. Okay, so whenever we're talking about buy-sell planning, it involves 2 separate steps. The first step is, do you have a legal agreement, meaning have Joe and I signed a legal agreement that when I pass away, Joe has the right to buy the shares from my wife? Okay, sometimes when I'm talking about buy-sell planning to business owners, they'll say rapidly, oh, I already have a buy-sell plan. If a business owner says that to you, the very next question should be, is it funded? Right, because just because Joe and I have a legal agreement that he can buy out the shares from my wife, where's that cash coming from? That's why life insurance is perfect to fund a buy-sell agreement. So if Joe and I have a business that's worth $1 million, we each own half, right? So my interest in the business is $500,000, and his interest would also be $500,000. So under a cross-purchase agreement, it's a very simple arrangement. I would own a policy that insures Joe, my partner, and I would pay the premiums. I would be the beneficiary. Joe would then own a policy that insured my life, and he would be the beneficiary. So again, we have that legal agreement, which is the buy-sell agreement. We've then funded it in a cross-purchase arrangement. So if I was to pass away, Joe, my partner, gets $500,000 of cash. He then approaches my wife with that legal agreement saying, oh, Trey, and I signed this. I have the right to buy the shares from you. Here's $500,000 in cash. Okay, so buy-sell planning is great, and life insurance is the perfect planning for that. Okay, again, there's a few different variations on this. But again, the most common when you see a two-owner business, this works great for two-owner businesses, cross-purchase agreement. Now, if you have three owners or more, we would suggest using a different type of arrangement called a entity purchase agreement. Okay, because the number of policies under a cross-purchase. So a good rule of thumb, two-owner businesses, cross-purchase agreements, pretty good idea. At least to start chatting about three owners or more, we probably want to talk a little bit more about what's called a entity purchase agreement. Okay, next slide, please. All right, like key person, these are often funded with term insurance, so that's great, whether it's 10 years, 15 years, 20 years, or 30 years, okay, depending on how much we're buying. We may be able to do it on a non-medical basis. Okay, we can always convert term products as well for longer term coverage. Also remember that on our term LB product that provides some living benefits. Now, most buy-sell agreements cover three risk areas. What happens if the owner dies, which is what we've been talking about. But they also cover what happens when the owner retires. And the third area is what happens when the owner becomes disabled. Right, so using a insurance product like our term LB that provides living benefits for a chronic illness, let's say, may be a good solution to provide access to those funds if that owner becomes disabled. Okay, next slide, please. All right, so we're kind of wrapping up here, so we're getting to the end. So again, this is really a team sport, right? I mean, this is sort of a process. Keep in mind, it's good to get that accountant involved. Also remember what we said in the beginning, this is a huge need. It's often overlooked. By doing business owner planning, makes yourself memorable, right? By partnering with tax advisors, you're not only going to help your business owner client, but you're going to gain access to another, 20 or 30 business owners, organically growing your list. And that really kind of solidifies the personal planning that you've actually done as well. Okay, next slide, please. All right, so again, as part of this, right, and we do a lot of these trainings, but the more you can think about insurance conversations as sort of planning opportunities, right, working with a team, as I said, it's very important to involve tax professionals, especially with business owners, get them involved sooner rather than later. If we're talking about buy-sell planning, we need to kind of figure out how much that firm's worth. There are some easy rule of thumbs with that. Attorneys also play into this as well. Okay, next slide, please. All right, in the resources, there's a link. There's a link to my LinkedIn page. So I'm getting pretty active on LinkedIn. I do a lot of videos and posts as well. So those three opening questions, if I went too fast for you, there's about a 90-second video on LinkedIn for that. Also in the resources tab is the website address for the Transamerica Advanced Markets page. We have a lot of good pieces up there, not only about business owner planning, but estate planning, living benefits planning, a variety of topics. Next slide, please. Oh, we're done. Okay, so there you go. So again, Trey Fairman with Transamerica Advanced Markets team. I want to thank the whole WFG team. I love working with you guys. This has been a great opportunity. Appreciate just being here and sharing what I know. Love doing it.